A home mortgage loan is a long-term loan used to buy a house or refinance an existing home loan, with the property serving as collateral. Most people use mortgages because paying the full purchase price in cash is not practical. A mortgage spreads the cost over many years, most commonly 15 or 30, allowing the borrower to become a homeowner while paying the balance down gradually. Because the lender has the right to take the property through foreclosure if payments stop, mortgages typically offer lower interest rates than unsecured loans, but they also come with strict qualification standards and significant paperwork. A typical monthly mortgage payment is often described as having 4 parts: principal, interest, taxes, and insurance. Principal is the portion that reduces the loan balance. Interest is the cost of borrowing the money. Property taxes are assessed by local governments and can vary widely by location. Insurance usually includes homeowners insurance and sometimes mortgage insurance. Many lenders collect taxes and insurance as part of the monthly payment and hold the funds in an escrow account to pay those bills when they come due. Even when your loan has a fixed interest rate, taxes and insurance can change over time, which means your total payment can rise or fall. The 2 most common mortgage types are fixed rate and adjustable rate. A fixed rate mortgage has an interest rate that stays the same for the life of the loan. This provides predictability because the principal and interest portion of your payment remains stable, which is helpful for budgeting. An adjustable rate mortgage, often called an ARM, usually starts with a lower introductory rate for a set period, such as 5, 7, or 10 years. After that initial period, the rate adjusts periodically based on a market index plus a margin. ARMs can be attractive if you expect to sell or refinance before the adjustment period begins, or if the lower initial payment is important for cash flow. The risk is that rates can rise, increasing the payment. Key ARM features include the adjustment frequency and rate caps, which limit how much the rate can increase at each adjustment and over the life of the loan. Mortgage terms also matter. A 30-year loan generally has lower monthly payments than a 15-year loan because the repayment is spread over more months. However, a 30-year loan typically results in more total interest paid over time. A 15-year loan often offers a lower interest rate and builds equity faster, but the payment is higher. Choosing a term is a trade-off between monthly affordability and long-term cost. Some borrowers choose a 30-year loan for flexibility and then make additional principal payments when they can, effectively shortening the payoff timeline without committing to a higher required payment. The down payment is the money you contribute upfront towards the purchase. A larger down payment reduces the amount you need to borrow, which can lower the monthly payment and often improve your loan terms. Down payments also affect whether you pay mortgage insurance. On conventional loans, if you put down less than 20%, lenders typically require private mortgage insurance, or PMI. PMI protects the lender, not the borrower, and adds a monthly cost until enough equity is built. PMI can often be removed later if the loan and equity meet certain requirements. Government-backed loans have different rules. Some require mortgage insurance premiums with different structures that may last longer depending on the terms. Different loan programs exist because borrowers have different needs. Conventional loans are offered by private lenders and often provide competitive rates for borrowers with strong credit and stable income. FHA loans are designed to be more accessible and may allow lower down payments and more flexible credit requirements, though they often come with mortgage insurance costs. VA loans are available to eligible service members, veterans, and certain surviving spouses, and can provide favorable terms, sometimes including no down payment or no monthly mortgage insurance, though they may involve an upfront fee. USDA loans support eligible rural and some suburban homebuyers and may offer low or no down payment options for qualifying borrowers. Each program has its own eligibility rules, documentation requirements, property standards, and cost structure. Interest rates are one of the biggest drivers of your monthly payment and total loan cost. Borrowers often compare rate quotes, but it's also important to understand the difference between the interest rate and the APR. The interest rate is the basic rate used to calculate interest on the loan balance. The APR, or annual percentage rate, includes the interest rate plus certain lender fees and costs expressed as a yearly figure. APR can help you compare loans with different fee structures, but it assumes you keep the loan for a certain period. If you plan to refinance or sell relatively soon, a loan with low fees and a slightly higher rate might be cheaper overall than a loan with a lower rate but high upfront costs. Points are a common element of mortgage pricing. A discount point is a fee you can pay upfront to reduce the interest rate. Paying points can lower your monthly payment and may save money over time, but only if you keep the loan long enough to break even on the upfront cost. The break-even point is how many months it takes for the monthly savings to equal the cost of the points. If you sell or refinance before that point, paying points may not be worthwhile. Some borrowers prefer to avoid points and keep more cash available for reserves, repairs, and moving expenses. Qualifying for a mortgage depends on credit, income, and overall financial stability. Lenders evaluate your credit score and credit history to estimate your likelihood of repayment. They also look closely at your debt-to-income ratio, which compares your monthly debt obligations to your gross monthly income. A higher ratio suggests less room in your budget for a new mortgage payment. Lenders verify employment and income stability, often using pay stubs, tax returns, and bank statements. They also consider assets available for down payment, closing costs, and reserves. Reserves are funds you have left after closing, which demonstrate you can handle unexpected costs or income disruptions. The property itself is also part of underwriting. Lenders typically require an appraisal to confirm the home's value supports the loan amount. If the appraisal comes in lower than the purchase price, the lender may not approve the full loan amount, and the buyer may need to renegotiate, bring more cash, or walk away depending on contract terms. Lenders also require homeowners insurance and may have property condition requirements, especially for certain loan programs. The mortgage process usually begins with pre-approval. Pre-approval involves a lender reviewing your documents and credit to estimate what you can borrow, which strengthens your position when making an offer. After you sign a purchase contract, the loan moves into underwriting, where the lender verifies details, orders the appraisal, confirms title, and finalizes the terms. Closing is when the paperwork is signed and the loan funds. Closing costs are paid at this stage and include lender fees, appraisal fees, title insurance, escrow setup, recording fees, prepaid interest, and prepaid taxes and insurance. Closing costs vary by location and loan type, so it's important to budget for them in addition to the down payment. A key concept in mortgages is amortization. Mortgages are typically amortizing loans, meaning each payment includes both interest and principal, but the proportion changes over time. Early in the loan, a larger portion of the payment goes to interest because the balance is higher. Over time, more of the payment goes towards principal. This is why extra principal payments early can have a meaningful impact on total interest paid and can shorten the loan term. If you make extra payments, it's important to ensure they are applied to principal rather than treated as advance payments of future installments. Once the loan closes, it is serviced, meaning a company collects payments, manages escrow if applicable, and handles customer service. Sometimes the lender keeps servicing, and sometimes servicing is transferred to another company. The terms of the loan don't change when servicing transfers, but the place you send payments can change, so it's important to watch for official notices and avoid scams. Refinancing is the process of replacing an existing mortgage with a new one. People refinance to lower the interest rate, reduce the monthly payment, shorten the term, switch from an ARM to a fixed rate, or access home equity through a cash-out refinance. Refinancing has costs, so it should be evaluated with a break-even analysis similar to points. If your monthly savings outweigh the costs within the time you expect to keep the loan, it may make sense. If you plan to move soon, refinancing may not be worth it. Cash-out refinancing can provide access to funds, but it increases the loan balance and may reset the loan term, potentially increasing total interest over time. Mortgage decisions are also influenced by risk and lifestyle. Buying at the maximum a lender approves can leave little room for unexpected expenses, and home ownership comes with costs beyond the mortgage payment, such as maintenance, repairs, and utilities. A safer approach is to choose a payment that fits comfortably within your budget, leaving room for savings and emergencies. It also helps to keep a cash buffer after closing because new homeowners often face immediate expenses like repairs, furnishings, and moving costs.